Last year's budget was the biggest tax-raising event since 1993, £40 billion. And after that, Rachel Reeves, our Chancellor, said this.
I'm really clear, I'm not coming back with more borrowing or more taxes.
Yeah, here we are. So why? Look, I won't drag you through every fiscal rule equation. We've got a lot to cover today. But I think the key point really is Chancellors need headroom. Headroom is basically wiggle room, the buffer between the rules that the Chancellor has set themselves and the amount of money that's coming in. The more headroom they have, the more things can go wrong without their whole plan falling apart. And Reeves had almost none of it. And then leading up to this budget, everything has been going against her. The OBR, the official forecaster, was rumoured to be downgrading growth. They do this a lot. Lower receipts means less headroom. And less headroom means that to stick to her own self-imposed rules, she has to find more money. That was the narrative coming into this. But if we actually review the OBR's official release, which we kindly got early, thank you for that, guys. Someone's had a really bad day in that office. On page 5, they said that the Chancellor's headroom pre the changes in this budget would have fallen from 10 billion to about 4 billion. But because of these changes in taxation and spending, it's boosted up to 22 billion. I do think it's worth pointing out that they're constantly reviewing these targets and they often move and get them wrong. So yeah, take them with a pinch of salt. But coming into this, the Chancellor's probably had more headroom than she expected, which is why she backpedaled on income tax rises that she was hinting at first. A lot of that is because she's brought in extra tax that she probably didn't expect to be getting due to the effects of fiscal drag and inflation, which we'll talk about in a minute. But she has still raised taxes all of the same. And I think the ways in which she's raised some of those taxes break some of the manifesto promises of Labour. But we'll get into that in a minute. I just want to focus, first of all, broadly on this promises point. In her first speech in July last year, Rachel Reeves promised to deliver stability.
I am restoring stability to our public finances.
Her and Keir Starmer's whole pitch was basically, we're not the Conservatives, we're a safe pair of hands, we will stop all the chaos. And yeah, we haven't had the same level of day-to-day scandals that we had with those lot, but the run-up to this budget has been anything but stable. Honestly, I think it's the worst lead-up to a fiscal event in my whole lifetime. The Chancellor has allowed rumours to just run completely wild. Most of them seem to have been leaked directly from inside the government itself. And as a result, every corner of the finance world has been speculating from all things from ISAs, tax rates, property, businesses, employment. It just seems like everything has come out. In 1947, Hugh Dalton was forced to resign as Chancellor for accidentally revealing a single sentence from his budget to a reporter minutes before speaking to Parliament. Today, it feels like the story is, well, what don't we already know? And this has real-world consequences, this rumour mill and all these leaks. It just makes everyone in the country stop and think, what if that change actually happens? I'll just wait to move house, I'll wait to hire anyone, I'll wait to invest in the UK. There's a real argument here that the uncertainty leading up to this budget has done more damage than the changes that we're about to discuss in a minute. Because uncertainty is the real killer of growth. At least now, everyone, people, individuals and companies know what's happening so they can just get on with their lives and crack on, essentially. But what I think might be even more concerning and a bit more telling of the times is there's a real possibility that the leaking of details ahead of the budget, so all of this stuff that we saw come out, was the Chancellor's attempt to influence the bond market so that she could make borrowing rates seem a bit more favourable leading up to it ahead of the OBR forecast. And that would give her more wiggle room. Essentially, she would maybe, I'm not saying that this is the case, I want to make that clear, but there's an incentive to potentially throw the economy under the bus short term to appease the forecasters and the bond market. Look, I just said a lot of things there. So let's just talk about why the bond market is really important and why that might come ahead of, short-term stability within the economy for the Chancellor. When the government announced the budget today, the first thing everybody watched wasn't the public reaction, it was the bond market's reaction. And that's because the bond market decides instantly how expensive the government plans that were outlined today are going to be long-term. As you can see, we borrow a lot of money. We also have almost £3 trillion worth of debt that comes with huge daily interest costs, hundreds of millions of pounds a day in interest we spend. So even a small movement in the yields on gilts are the names for UK bonds, and those bonds are the way that the government borrows money. But yeah, even a small change to the cost of borrowing can mean tens of billions of extra spending for the government. And today the yields on those bonds can move faster than ever because the buyers of government debt have changed a lot in recent history. Instead of slow and steady pension funds who hold these things to maturity, it's hedge funds, it's banks, it's asset managers who are trading them constantly, reacting to everything that the government does and projections for the UK economy, meaning the bond market reacts quicker overall as well. You might have heard the term bond vigilantes. This was coined by Ed Yardeni in the 80s. He argued that if governments were irresponsible with spending and borrowing commitments, that the bond market would force them to rethink. That's why the Liz Truss mini-budget caused such chaos. When she announced tens of billions in extra borrowing, it sent the bond market into a panic. Pension funds nearly failed, and that Prime Minister was gone within weeks.
I am resigning.
So how have the bond markets reacted? They've come down a bit. There's been a slight improvement in the cost of borrowing for the government. They spiked initially when the OBR leaked that document, but have then since come back down. The bond market should like the fact that the Chancellor has given herself more headroom going forwards. But it's a bit like us, really. The market knew everything that was coming today. So there was no big surprises, which means that a lot of this was just priced in. The biggest story really with the cost of borrowing is when you zoom out. Just look at what's happened to the cost of borrowing in the last 5 years. So how should you react to this? There are loads of things going on in this, loads of tweaks and tinkering all over the place. I'm just going to focus on some of the main tax changes today because I think those are the things that are most relevant to the people who watch these videos. I'm not going to look at the minimum wage or living wage changes or the two-child policy thing, mainly because I want some time to think about these things. I think that on first view, they're great for loads of people, for young workers, for low earners and for families, of course. But I wonder if there's some other implications and ramifications of these kinds of decisions that we should consider. I'm going to put that question to the director of the IFS, who I'm going to interview on Monday on the podcast. We're going to deep dive on this because we're going to be speaking for over an hour and we're going to go over all of the aspects of this and what it means for the economy and for individuals in much more detail than I have today. I'll link the podcast below in the pinned comment for you if you want to check out where that's going to be on Monday. But yeah, I'm going to focus on taxation today, and I want to start with this.
By backing working people, not making them poorer.
The Chancellor made a huge deal about not raising tax on workers. Labour promised not to touch the big three taxes, income tax, NI and VAT in their manifesto. Some would say that they've already broken this pledge because of the increases in employers' NI in the past. But today, in my opinion, they've definitely broken that pledge because they've committed to freezing income tax bands from 2028-2029, extending the current freeze. I feel like I've done nothing but talk about fiscal drag now for about 4 years, yet here we are again, they're up to the same old tricks. If you don't raise tax bands in line with inflation, you take more in tax by stealth. This freeze is estimated to raise around 8 billion. It will push around 780,000 more people into the basic rate tax, 920,000 people into higher rate, and 4,000 people into the additional rate. The freezes already in place were projected to cost the UK 38 billion a year by 2030, which would have been around £1,266 for every working adult in the UK. And it's not just workers, I should add. Because of the triple lock, the state pension is currently rising faster than these thresholds because they're frozen. Next April, the state pension is forecast to go up by 4.8%, which will cost taxpayers about 6.7 billion extra every single year, which is almost as much as these freezes raise or are estimated to. Many pensioners live on just the state pension, and what that means is they're going to get to a point where they will be dragged into a taxable position because the state pension will be more than the tax-free threshold. It's sort of a bizarre setup, really. Honestly, I'd rather they just raise income tax by 1 or 2p. At least it's honest. Freezing tax thresholds just leaves tax policy at the mercy of inflation and wage growth. In fact, the only reason the Chancellor has more headroom today that we discussed earlier is because inflation and wages have come in higher than she expected, meaning fiscal drag has delivered more tax to her, so she's benefited from that. I'll leave a calculator below that works out what fiscal drag will cost you if you want to have a play with that. But the TLDR is if you pay any form of income tax, this has cost you money and will cost you more now. One last thing on this freeze, one glimmer of hope. These changes are coming at the end of this parliament, so it's likely going to be an election year. How credible is it then that they will actually happen? Is a government that I imagine will be fighting for its life really in an election year going to commit to big tax increases? Or might they pedal this back and go, we're going to increase your tax-free thresholds just so you like us a bit more? I'm not convinced because I think that this is an easy thing for opposition to attack at a key time for them. And I can see them undoing this in political weakness. And really, they're only putting it in at the minute to give themselves some headroom, knowing that they're probably going to wind it back at that point anyway. but we shall see. But when you look at the main budget document, you see large amounts of planned tax rises coming from holding bans in place, and not just with income tax. They say 12 billion from the income tax rises, 925 million from employer NI, and 380 million from freezing student loan repayment thresholds. But yeah.
Backing working people, not making them poorer.
This whole section is called Raising Revenue Fairly, and it's just a long list of all the taxes they're bringing in. Let's go through some of these quickly and look at how much they think they'll bring in. They're bringing in extra taxes on landlords. They're basically adding 2% to their income tax bands from revenue that's derived from letting out a property. And this comes in on the 6th of April 2027. The thing I consider is that this won't be on limited companies, so professional landlords. It will be on landlords who hold properties outside of a limited company in their own personal name. 45% of all of the landlords in the UK own one property. The majority of those people who own that one property will hold it in their personal name. And normally this is kind of the result of maybe a parent died, or it's a couple that move in together and they had like a flat or something before and they keep it. So this tax doesn't target these kind of large industrial scale landlords or the professional outfits that I think many people have in their mind when they think landlord. It's often accidental landlords and individuals that are being penalised by this sort of tax. There's also an extra 2% tax on dividends added to the ordinary and upper rate. This comes in April 2026. A good way to think about this is this will cost you an extra £200 for every 10k of taxable dividend income that you receive. Shed a tear for me, please, because I will be paying this on the income that I take from my limited company as a director, and so will anyone who has investments outside of tax-efficient accounts who receives a dividend income in excess of the current tax-free rate of £500. They think this change will raise 1.39 billion in 2030-2031. There's tax on savings income said to raise 505 million. Now, this is interesting in the context of the news we're going to discuss in a minute of cash ISAs being cut, as more people than before will likely save cash in ways that exposes them to a potential tax bill. And then the government is increasing the size of that bill at the same time. Capping salary sacrifice will raise 2.5 billion from 2029. So I think this is a big one. One of the best ways to avoid fiscal drag is to use a salary sacrifice scheme, because you get to put your money into a workplace pension or a pension of your own choice, and you literally sacrifice salary, you reduce your salary on paper, so you avoid some of the impacts of that fiscal drag. You also benefit from NI savings on both sides, both you and the employer, and sometimes the employer will pay those into your pension. By cutting this, again, the Chancellor is dancing very close, in my opinion, to that line of breaking the fiscal rule around increasing NI or not, because this will increase the amount of NI that lots of workers pay. It also just removes an incentive to pay into your pension for certain people. This is at a time that the UK is looking to incentivise people to invest and put money into their pensions. It just seems a bit backwards to me. Now, you still have other means of paying into your pension, sure. They're just less generous. I think this is one of those where it could be scrapped again. It's well off in the distance. But for now, make the most of your salary sacrifice scheme while you can. Okay, a couple more here I want to draw attention to. So we have the high value council tax surcharge, or a mansion tax really. The paper states that the average Band D family home pays more in council tax than a £10 million property in Westminster. So this government is introducing a higher value council tax surcharge on homes worth over £2 million. The details of this can be shown on page 36. It shows it comes into force in April 2028. As we said, it's houses over £2 million, and they'll be updating valuations to identify properties above this threshold. Hopping onto Zoopla, I imagine. There also appears to be a taper in place where it ranges from £2,500 at the £2 million range up to £7,500 on a £5 million house. And that is payable by the owner, not by the occupier. So all you people renting a £5 million gaff, you're safe, unless your rents go up. Now, I've often said that if you want a wealth tax, council tax is an obvious place to start. It just needs reforming. This isn't reform, it's just added complexity in a way. They said they're revaluing homes for this, so why not do that for all of them while they're at it and just create a more progressive council tax system? But it is a wealth tax and it's hard to avoid because you can't take the house to Dubai, can you? Now, one concern is there doesn't appear to be any form of indexation. So what I mean by that is the £2 million doesn't go up in line with inflation or anything like that. So in 20 years, we could have loads more people living in £2 million houses because of inflation, basically, and the impact of pushing up house prices over time. And if this allowance doesn't go up, they're going to be hit by this tax. And call me a cynic, but with all the fiscal drag that's going on all over the place, I can't see them putting this allowance up anytime soon. Also, 2,500 is 0.125% of 2 million. 7,500 is 0.075% of 10 million. So this system means if you have, say, a 10 million quid house, it's actually relatively cheaper percentage-wise than being in a 2 million quid house. Why? Well, I give an example of a 10 million quid home in the paper and then set this tax up so it penalises those at the lower end of the distribution more than when you get to like 10 million quid. I know, boo-hoo for the person living in the 2 million quid home, but there is a world where you can imagine someone living in a house worth that much has essentially just got lucky buying in the right area at the right time decades ago, and now the house price is worth 2 million quid. Whereas there's a big difference between a £2 million house and a £100 million house. That £100 million house might belong to someone who owns £100 million houses in 12 other locations around the world, so only spends a month in each of them, and they use them as piggy banks just to park money in different countries, basically. Penalise them. Hammer them with tax. Say to them, if you want to park money in our country in the form of property in our most expensive homes and then never actually use them or contribute to the society much, pay 200 grand a year for the privilege. That's kind of how I would have set up the tax. I would have made it really progressive. I would have ramped it up really highly on these ultra high-end properties at the top. Also, this band here is likely going to create lots of weird distortions at this end of the property market. How many houses are you going to see listed at £1,999,999 now? Because this tax only applies to a small amount of houses, it's set to raise a small amount of money initially, 400 million from the point it gets in. But it's also interesting that they think this tax will cost them money in the short term. The changes continue on and on. I've linked the full document below and it's on page 91 and 92 to have a look at these. But these changes are expected to raise 26 billion by 2029, 2030. That's an extra 26 billion on top of the tax rises we had last year. Okay, the last thing I want to talk about is the cash ISA changes. The rumours of changes to ISAs that have been floating around for years have actually happened this time. From April 2027, the Chancellor will change the limits on ISA products. She said this:
I will reform our ISA system, keeping the full £20,000 allowance, while designating 8,000 of it exclusively for investment.
That is a really funny way of saying I'm reducing the cash ISA limit to 12 grand. She will allow people over the age of 65 to keep the full 20k, flexibility across the ISA allowances. And I do think it's a good move to single out that cohort because in retirement you need higher cash savings due to the need to live off that cash and hedge against stock market downturns. But I think any suggestion from anyone that this will encourage people to invest is just silly. You don't encourage actions with money via like a stick like this. You need a carrot, you need education. Most people think the stock market is just too risky, so they don't touch it. That's why they put all of their money into cash. You need that education piece alongside this. And while the government has mentioned there's going to be support for education through banks, we rank investment account providers on my website, Financial Interest, and many high street banks score really bad on investment product offerings. I'm worried that people are just going to be ripped off by these guys, basically. I hope that support around education extends to providers in the space, brokers who specialise in the stock market, and also to creators like myself, who I think do good work in educating the population, much better than the high street banks. What I think is actually going to happen, though, is more people will just put cash savings into taxable accounts that used to use the cash ISA, so the government will benefit from this because they'll see more tax revenues from people that generate interest above their personal savings allowance. I also think that we're going to see loads more money flow into premium bonds, which will also benefit the government because it's a relatively cheap way for them to borrow money. The rates on premium bonds are below, the rates on 10-year gilts. So it's cheaper for them to borrow via that method. I thought these charts were interesting on the last pages of the budget document. They outline planned spending and taxation for 2026-2027. So in that year, they expect to bring in 1.3 trillion in receipts, of which 1.168 trillion is from tax. In 2023, as a comparison, they raised 1.06 trillion. So it's an extra 100 billion a year, nearly 10% extra on the tax take over that period. When it comes to spending, while we'll bring in 1.3 trillion, they plan to spend 1.4. Where do we get the difference from? All hail our bond overlords. The story of today should have been, I should have been sitting here going, we've had loads of tax increases. And since 2010, only 2 budgets have cranked tax higher in percentage terms than the one today. And one of those was last year. Now, while this is shocking, I don't think anyone is shocked. It's a non-story because we sort of knew this was all going to happen. And I suspect many people will be sat there thinking, this could have been a lot worse because of the rumours that swirled around this prior to the event. I think those leaks are the story. The damage caused by all those rumours leading up to this budget and just how long it went on for is going to be bigger than the damage caused by the budget itself. The OBR farce is just the cherry on the cake with this whole leak fiasco, and I think the Chancellor deserves that embarrassment for allowing speculation to run wild prior to this event. I also personally think that she should have been a lot braver with much bigger tax reforms than this. Instead, she's just choosing to do the same old, this pretending not to tax workers while hammering them with fiscal drag at the same time. At what point, honestly, will these temporary freezes actually stop? Like I said, I'm going to be interviewing the director of the IFS on Monday, and at that point I'll have had more time to consider things, the impacts on the economy and businesses and stuff like that. One of the benefits of interviewing the director of the IFS on social media is that if you've got a question for her, I can ask her, so submit your questions below and I'll try and ask as many as I can. And thank you for your time today, guys. Let me know what you thought on the budget below as well.